Hello there, Nathan Duffy here, and I'll be your guide today as we travel through the exciting world of investments in marketable securities. Together we will explore how to treat trading, available for sale, and no significant influence securities. We will also discuss the treatment of realized and unrealized gains and losses. First off, let us begin with the financial treatment using the fair market value method. Adjustments are made each time financial statements are produced to adjust for unrealized gains and losses. The purpose of this adjustment is to report investments with no significant influence at their fair market values. The journal entries would be as follows. To record the purchase of a trading security, the journal entry would be recorded as a debit to trading securities and a credit to cash. At year end, when the security is revalued, if the revaluation results in a gain, the journal entry would be debit to the market adjustment account and credit to unrealized gain. If the revaluation results in a loss, the journal entry would be debit to unrealized loss and credit to the market adjustment account. Accounting for available for sale securities is a bit different. To record the purchase, you debit the AFS securities account and credit cash. If at year end the revaluation results in a gain, the journal entry is debit to the market adjustment account and credit to unrealized gain. If the revaluation results in a loss, the journal entry is debit to unrealized loss and credit to the market adjustment account. The financial treatment at the date of sale using the fair market value method would be to recognize any realized gains on the date that they are sold. The journal entries for these would be as follows. To record the sale of an available for sale security, you simply debit cash and unrealized gain and credit gain on sale of AFS securities, and the market adjustment account. To record the sale of a trading security, you debit cash and credit gain on sale of trading securities, and the market adjustment account. Now let's move right along to the tax treatment of investments in marketable securities. For purposes of income tax, no gains or losses are recognized until they are realized. No unrealized gains are recognized. Some of the trickier parts of accounting for investments in marketable securities result from the differences between the book and tax treatment. The differences between book and tax when accounting for unrealized gains and losses on trading securities create books to tax differences in years that the fair market value of the securities is either above or below the value at which the securities were purchased, plus any associated commissions. If the fair market value of the securities is above the company's basis, then a deferred tax liability is created since the company is required to subtract the amount of the gain from book income in order to arrive at taxable income. The opposite result occurs when the fair market value of the securities is below the company's basis. In this situation, a deferred tax asset is created. For example, a trading security is originally purchased by Randy's Radiators in 20x3 for $100. During 20x4, it appreciates in value to $150. On the books, this gain of $50 is recognized in the income statement in 20X4, even though the trading security is held until it is sold in 20X5. In 20X4, a deferred tax liability will be created for the $50 gain that is recognized for book purposes, but not for tax purposes. In 20X5, the trading security is sold to a third party for $150. Now, in 20X5, the $50 gain is recognized for tax purposes. Along with this, the deferred tax liability will be reversed. In the year of the sale, there will be book tax differences resulting from the reversal of the deferred tax assets or the deferred tax liabilities previously recorded. For tax purposes, the full gain or loss will be recognized in the year of the sale, whereas for book purposes, only the portion of gain or loss realized since the last adjustment will be recognized. It is also important to note that since unrealized gains and losses on available for sale securities do not go through the income statement, no book-to-tax differences are created. Other issues include whether or not the company is considered a dealer. If the company is considered a dealer for tax purposes, the gains or losses would be classified as ordinary and could be used to offset ordinary gains and losses. If they are not considered a dealer, the loss would be classified as a capital loss and therefore create a deferred tax asset in the form of a capital loss carryforward. The carryforward could be used to offset any capital gains in the past 3 years as well as any future capital gains for the next 5 years. I hope you've enjoyed our adventure today as we've traveled through the exciting world of investments in marketable securities. I hope you have a wonderful day.